Most people think you have to pay taxes in retirement, but I'm going to show you how we are helping one of our clients legally pay zero taxes on $120,000 of retirement income. One of the most popular videos on our channel is called How to Pay Zero Tax on $100,000 of Retirement Income. And for good reason. Who wouldn't want to keep 6 figures of income and not give a dime to the IRS? But here's the thing, that video, it's outdated. And since then, Big Beautiful Bill has passed and brought some major tax changes that give retirees new way to pay zero tax if you know how to work the tax code. So in today's video, I'm going to walk you through what's possible under the new rules because we just set up a plan for our client to generate $120,000 of retirement income this year and pay zero in federal taxes. And no, this doesn't require any fancy Roth conversion strategy. They didn't even need a Roth IRA in the first place. Just a smart income plan that takes advantage of the new tax code. So if you're looking to make every dollar count in retirement, this one's for you. Now, before we look at how to create $120,000 of tax-free income in retirement, we need to look at what $120,000 looks like if you're still working, because most people underestimate just how much of their paycheck disappears before it ever hits their account. So let's say you're earning $120,000 in W-2 wages, you're over age 65, and you file a joint tax return. So as you'll see here, we've got $120,000 of wages and $34,700 in deductions. That's made up of the $31,500 standard deduction for married couples filing jointly under the Big Beautiful Bill, plus an extra $1,600 per person over age 65, which brings us to the $34,700 total. But here's the twist. That's not the full picture. There's a brand new deduction you won't see listed here. So under the new rules, there's an enhanced senior deduction, $6,000 for each spouse over age 65. That's an extra $12,000 in deductions for this couple. Now there are income limits. So for single filers, it starts to phase out at $75,000, and for married couples, it starts phasing out at $150,000. But in this case, they qualify. And even with all that, they still owe $8,319 in federal income tax. Now that's because their taxable income of $73,300 falls across the 10% and the 12% brackets. And that's how we arrive at the total. But we're not done yet. We still have to account for FICA taxes, 6.2% for Social Security and 1.45% for Medicare, which adds up another $9,180. So when you add it all up, the total tax bill is $17,499, which means they keep just $102,501 out of the $120,000 they earned, roughly 85% take home. Now, here's the exciting part. When you're retired, you have a lot more control. You can choose how to pull income, what buckets to use and when, and that control can let you keep all of that $120,000 instead of sending a chunk of it to the IRS. And that's exactly what we're going to look at next, because I'm going to introduce you to a real client, Dave and Sandy, and I'm going to show you how we help them generate $120,000 of income in retirement and pay nothing in federal taxes. So our clients, Dave and Sandy, are a married couple, both age 66, who came to us looking for ways to keep more of their income in retirement without being hit hard by taxes. Each of them is collecting Social Security. Dave's benefit is $3,100 per month, and Sandy's benefit is $2,400 per month. They also have a joint brokerage account worth $800,000, invested in an S&P 500 index fund generating about a 1.2% annual dividend. The cost basis in that account is about half. So when they sell investments to take withdrawals, 50% is treated as long-term capital gains, and 50% is a return of basis. And finally, they got IRA accounts with a total balance of around $1.2 million. Now, it doesn't matter if your numbers don't match theirs, because the principles I'm about to walk you through are applicable whether you've got $200,000 or $2 million. It's about how you layer your income and take advantage of how the tax code works, especially with the recent changes under the Big Beautiful Bill. Now, Dave and Sandy were a bit skeptical at first. They just assumed there was no way to pull $120,000 of income and avoid paying taxes, but that's exactly what we help them do. And remember, everything I'm about to show you is something that you can do too. And no, it doesn't require fancy strategies or even a Roth IRA, just a smart income plan. So let me walk you through exactly how we built theirs step by step, starting with the foundation, which is Social Security. Because like I mentioned earlier, this isn't about doing anything fancy. It's about building up their income in layers and taking advantage of how each source is taxed. Dave's benefit is $3,100 per month or $37,200 annually, and Sandy's is $2,400 per month or $28,800 a year. So combined total, $66,000 of Social Security benefits per year. Now, Social Security can be taxable up to 85% of your benefit depending on something called provisional income. That includes half of your Social Security plus other income like dividends, IRA withdrawals, capital gains, and so on. But as we will see here, even though their Social Security is $66,000, only $500 is taxable. And that's because their provisional income is low enough that nearly all the Social Security benefits are tax-free. And with $500 of reportable income, their deductions are much larger than that of $500, so no taxes due. So $66,000 of income has been added and no tax due, of course, but we are still far off from the $120,000 mark we want to reach. But this gives us a clean starting point, a tax-free floor, which we can build on. Now let's add on the next layer of income, which are qualified dividends from their taxable brokerage account. They've got $800,000 invested in an S&P 500 index fund with a 1.2% dividend yield. So that adds another $9,600 a year in qualified dividend income. Now, as we will see, with the addition of that $9,600 in qualified dividends, more of their Social Security benefits have become taxable. Again, that's because of how provisional income is calculated. We see that their total income is $14,900. But of course, their deductions are still larger than the total income. So we are still in a place where taxable income is zero. So if we are keeping track of their income with Social Security and dividends, Dave and Sandy's gross income is now $75,600 and their federal tax is still zero. We are making progress, but let's keep going to reach their $120,000 goal. Next, we'll add strategic withdrawals from their IRA. They've got about $1.2 million saved between their IRAs. So we're going to take a small amount, but we have to be careful to not push them over key tax thresholds. So now we're going to look at taking out $14,400 this year. Now, ultimately, it doesn't matter which IRA it comes from. So for this example, we will just take it from Dave's IRA. Now, what we will see here is, again, as we generate more taxable income, more of their Social Security benefits are becoming taxable. And now their total income is $41,050, which exceeds the $34,700 standard deduction. But taxable income still shows zero. So you might be thinking to yourself, well, is there a mistake here? Because this is where the updates to the big beautiful bill really shine and completely change this income plan. So as we'll see, the income does exceed the standard deduction, but we can't forget there is the enhanced senior deduction of $6,000 each. So they get a new $12,000 deduction, which completely wipes out their taxable income. So with the new tax updates, we are still at $0 of taxable income and zero tax. We are getting close, but we are not yet there at $120,000 of tax-free income. So we've got $30,000 left to hit our target. That brings us to our final layer, a withdrawal from their taxable brokerage account. And here's how that works. Of the $800,000 in the account, about half is cost basis, meaning non-taxable return of principal. The other half is gains. Now, typically when you sell an investment at a gain, it causes you to pay more taxes. But here's where we can take advantage of the 0% long-term capital gains bracket. So if they were to carefully sell and withdraw $30,000 from their taxable brokerage account, only $15,000 is taxable long-term capital gains and $15,000 is a non-taxable return of basis. Again, we would generate and send them $30,000 from the brokerage account, but only half of that is taxable. Now with Social Security, qualified dividends, IRA distributions, and this distribution from their brokerage account, we have officially reached $120,000 of income. But let's see how this looks. We will again see more Social Security benefits becoming taxable. Their total income is $68,800, but taxable income now shows $22,100. So you might be looking at this and saying, well, hold on, they have taxable income now. So did we miss the mark? Did we just ruin this plan? Did we not hit $120,000 of income at zero tax? Well, not necessarily, and here's why. Their taxable income shows up as $22,100, but remember our tax code can be complex and different types of income are taxed in different ways. What you'll see here is that the $22,100 of reportable taxable income would be taxed at the 0% long-term capital gains rate. That's coming from qualified dividend and the long-term capital gain from the brokerage account withdrawal. So although there is taxable income, it would not create any tax for them. And just to recap the scoreboard, $66,000 from Social Security, $9,600 from qualified dividends, $14,400 in IRA withdrawals, $30,000 from brokerage account, which again, $15,000 is taxed, the other half is not taxed. That's $120,000 of income and not a dime going to the IRS. Now, if you're watching this and you're saying to yourself, I wish I had a personalized plan just like Dave and Sandy, that's exactly what my team and I specialize in. You can visit our website at onedegreeadvisors.com to schedule a call, and we'll help you map out your tax efficient retirement. Now, this kind of plan used to be possible at around the $100,000 level, but with the big beautiful bill expanding deductions and adding the new enhanced senior deduction, the possible income amount just got even better for retirees. So here's what I want to show you next. What would have happened if we ran this exact same income plan under the old tax rules? Because the truth is the big beautiful bill changed the game, but if you're not up to speed on what actually shifted, you could be leaving money on the table every single year. So as we'll see here, under the previous tax code for this income plan, Dave and Sandy would have owed about $1,100 in federal tax on that income. But under the big beautiful bill, their federal tax bill would be $0. It's the same income, same investments, the same people, but thanks to a larger standard deduction and the enhanced senior deduction, they got to keep all $120,000. So here's the point. Retirement tax planning isn't just about what you used to know. It's about what's true right now. And these rule changes, well, they don't just save you money this year. They change how much you can withdraw, how you gift, how you convert to Roth. They touch everything. Because while this strategy works now, it likely won't work forever, because there is a window, and if you miss it, you could be stuck paying way more than necessary. And this is a critical point, because if they don't take steps to manage their tax exposure now, that IRA is just going to keep growing and growing, and it could turn into a tax bomb later. Once they reach their 70s and required minimum distributions kick in, that could mean many things, higher taxes on their Social Security, IRMA surcharges, and more of their income being taxed at higher ordinary income rates. And it all happens just because they delayed making a plan. So what do we do instead? Well, here's where long-term strategy kicks in. Right now, Dave and Sandy are in a zero tax situation, which makes this the perfect time to be proactive. We can start introducing things like tax gain harvesting, where we sell appreciated investments to realize gains at the 0% capital gains rate. That resets their cost basis, gives them more flexibility later on, and keeps their future taxes lower. Or we could look at gradual Roth conversions, taking a portion of their IRA and moving it into a Roth while they're still in a low bracket. And then that way, when RMDs hit, they'll be much smaller. So the big idea here isn't just about saving taxes this year. It's about creating a plan that reduces your lifetime tax bill, because the earlier you act, the more options you have and the fewer surprises you'll face down the road. So if you're in a similar spot, maybe you've saved most of your money in pre-tax accounts like either a 401k or an IRA, and you're wondering, how do we minimize taxes over our lifetime? That's exactly what I'll walk through in this next video, where I'm going to look at a real case study where someone had nearly everything in pre-tax dollars and how we built a plan to turn that into a tax efficient retirement income plan. Click right here and I'll show you how it works.